Good evening, students. Welcome to this class. I see a lot of doubts from you, Namita. In rectification by ICAI, is there time limit for assessee or AO to file the application? Namita, as I had explained you in the last class, so ICAI, there is this rectification within 6 months, if that's suo motu. If it is application by assessee, that has to be within the 6 months time frame. So if there is any application which is made, that has to be within the 6 months time frame, and the order can be passed after that also. I hope that is clear. So we had done one case law also for that, if you remember. Right? There was a Supreme Court judgment for that, Namita. It is possible even in the case of AO or in the case of assessee also. So where the application for rectification is made by AO or the assessee within 6 months from the end of the month in which the order which is passed, then in that case, that is all right. There is no problem in that. So even assessee or AO, both is possible. As settlement commission is higher than CIT appeal, so how CIT appeal can handle appeal of orders decided by settlement commission? I didn't get your question, Namita. Where did I say that the CITA will take up the settlement commission order? I didn't say that. So we have nowhere discussed that thing. If you can refer to me properly which section you are talking about. In section 256B, every notification after it issued date before the Houses of Parliament. So if the notification is already followed by public. No, Namita, if anything is being amended under the Act, or if there is something which has to be taken approval, then it has to be to the Parliament, right? Any amendment which is being coming up, that is to be in accordance with the approval by the Parliament, right? Even the public is following, there cannot be any notification issued tomorrow. I cannot issue a notification to say that this has to be followed by the public from next year onwards. It has to be in accordance with the authority of law. Is that clear? Okay. For 194 LC, yes. Infrastructure, rupee denominated bond, all of them, Namita, are covered there. I hope that is clear. Okay. Let's move further then. I hope we have revised the appeal chapter. We'll take up few questions from that chapter itself before we proceed to the next topic, which is penalties, what we are going to discuss today. So before we proceed on to the next topics, we are going to talk about we are going to discuss the questions of the appeal chapter. Okay? Okay, let's proceed further then. So my first question to you is, from your module itself, let me just open up the question for you so that you can also see it. You need to give me your answers. Okay. So this is the question before you. An income tax authority did not file an appeal to the ITAT against the order of CITA, decided against the income tax department on a particular issue. In case of one assessee LP for AY 21-22 on the ground that the tax effect of such dispute was less than the monetary limit prescribed by the CBDT. In AY 22-23, similar issue arose in the assessments of LP and her sister Palki which was decided by the CITA against the department. Can the Income Tax Department move an appeal to ITAT in respect of AY 22-23 against the orders of CITA for Alpi and her sister Palti? So give me the answer very quickly. What do you think? Can the Income Tax Department move to ITAT for the next year in respect of the same assessee as well as the other assessee if in the earlier year they had not been able to file the appeal due to low tax effect? That's the question. We have discussed that already. So quickly give me the answers for that. Yes, correct, Akshay. Whether for one assessee or for both? Very quickly. Can department file the appeal or not? What did we discuss in the last class? Quickly tell me. It should not take so much time to answer. Okay, so in this case, yes, the Income Tax Department can file the appeal because what did we discuss in the last class was that if, say, for example, for any year, the Income Tax Department is not able to appeal due to low tax effect, then it will not be construed that in the next year also, it will not be construed that the Income Tax Department has accepted the case. It will not be considered in that way. Neither the Income Tax Department will be precluded from filing the appeal on the same issue in the another assessment year, either for the same assessee or some other assessee. So therefore, Income Tax Department can very well move for an appeal to the tribunal against the order of CITA in respect of the next AY for both Alpi as well as for Palpi. Is that clear? So we had discussed that provision already. Clear? Okay. Next question. A petition for stay of demand was filed by XYZ Limited before ITAT in respect of a disputed demand for which appeal was pending before it. The ITAT granted stay while order dated 1st January 22 for a period of 180 days from the date of such order on deposit of 20% of the amount of tax by XYZ Limited. Thereafter, the bench was functioning intermittently till 1st February 23, and therefore the disputed matter could not be disposed of. In the meanwhile, in June 22, XYZ had made an application for extension of stay and was granted the extension up to 31st December 22. Thereafter, on 5th of January 23, the AO attached the bank account of XYZ Limited and recovered the amount of rupees 15 lakhs against the arrear demand of rupees 25 lakhs. The company requested the assessing officer to refund the amount as it holds stay over it. The AO, however, rejected the contention of the assessee, stating that the stay period expired on 31st December after which the order of stay stood vacated automatically. Examine the correctness of the contention of AO. What do you think? So what AO has done is, AO has attached the bank account and has started the recovery proceedings. Because according to AO, the 365-day period has expired. And the stay has got automatically vacated. So in this case, whether the action of the AO is correct or not, what do you think? What do you think? Whether the AO has done it correctly, whether the stay order will get vacated. Namita, 251 doesn't say that the CIT appeal can handle the cases decided by settlement commission. 251 just says that the assessment order which is passed after the settlement commission's proceedings have abated. So settlement commission did not decide anything. Settlement commission's proceeding had abated. And then if the settlement commission's proceeding had abated, the assessment will take the seat. So settlement commission did not proceed only with that case for whatever reasons. So it went back to the AO and then the assessment order was passed. So that assessment order is going before CIT appeal and not the order of the settlement commission. If you know, the settlement commission's order cannot be appealed. Those are final. Why, Santosh, do you think that the contention of the AO is not correct? Please give me the reasonings also. We have discussed and done all of this, so I'm expecting very, very quick answers because this is all what is discussed. Yes, Akshay, correct reasoning. Yes. So, ITAT has the power to stay the proceedings, to stay the recovery proceeding. However, as we have discussed, that cannot exceed 180 days from the date of order, subject to the condition that the assessee deposits 20% of the amount of tax, interest, fee, penalty, whatever. Further, it can extend on the request of the assessee, it can extend the stay for another period, but the original period of the stay and the extended period should not exceed 365 days. Right? So if the assessee makes an application, then the ITT can further extend the delay, further extend the stay if the delay is not attributable to the assessee. However, the total stay will be 365 days. After 365 days, the provision says that you have to vacate the stay. The stay will get vacated automatically. So the total period allowed is 365 days only. If the tribunal is, even if the delay is not attributable to the assessee, then in that case also the stay will get vacated automatically. But we had the Supreme Court decision in the case of Pepsi Foods, where they struck down this provision and said that only if there is a delay in disposing of the appeal, which is attributable to the assessee, then only the stay will get vacated automatically after 365 days. In this case, the appeal was not heard by the bench because the bench was intermittently functional. So the delay is not attributable to the assessee. And here, if the extended stay had expired on 31st December, the recovery proceedings by the AO were not in order since the delay in disposing of the appeal is not attributable to the appellant. Is that clear? So the stay will not get vacated in this case. Why, Namita, you think AO is correct? Did you understand now? AO is not correct because the bench was not functional. Is that clear? Because the bench was not functional and therefore in that case the AO's order was not correct. Clear? Is that clear? Last one question from this particular chapter before we move on to the next chapter. Question number 9A. The Commissioner of Income Tax issued notice to revise the order passed by the AO under Section 143. During the pendency of proceedings before the Commissioner on the basis of material gathered during the survey under 133A, after issue of the first notice, the CIT issued a second notice, the content of which were different from the content of the first notice. Examine whether the action of the CIT is justified as to the second notice. So what CIT has done that? CIT initially issued the notice to revise the order passed by the AO. So CIT issued the notice under section 263. And when the proceedings were pending, he issued the another notice based on the material gathered during the survey conducted under 133A. So can he issue a second notice? Is he justified? That is the question. Now, if you read 263, if we go to 263, right? What does 263 says? 263 says that the CIT, after examining the material on record, if he feels that the order passed by the AO is erroneous, insofar as it is prejudicial to the interest of the revenue, he will make an inquiry and then give an assessee an opportunity of being heard and will pass an order relating to the enhancing or modifying the assessment. Is that clear? So 263 always talks about that the CIT will conduct the inquiry. After examining the materials on record, he will, if he thinks that yes, there is a case that the assessment order is erroneous, in that case only he will issue a 263 notice. So first and foremost thing is that the CIT may call for and examine the record of any proceeding under this act. So the first job of CIT is that he will call for and examine the records of the assessment proceedings, and only if he can, or any other records which he might have it, right? So only if he is then of the opinion that the assessment order is prejudicial to the interest of revenue, then he will issue a notice for 263. Right? Now, in this case, what do we understand by the term record? Record is defined under section 263 to include all the records relating to any proceedings under the Act available at the time of examination by the PCIT or CIT. So records means what? Any record relating to any proceedings under that which are available at the time of examination. Now in this case, what happened exactly was that the first notice was issued and then the survey material was available before the CIT. And then he issued the second notice. So whether that is justified, the answer to that is no. That is not justified. Because what do the record definitions say? That the records which are there, any information or any material which is available before the CIT, which were not in existence at the time the assessment was made, and later on came into existence, can be taken into consideration by the CIT. Can be taken into consideration by the CIT. So records definition, what do they say? Any records of any proceedings under the Income Tax Act. So any material or information which was not available at the time of assessment, but which has later on come into existence or to the notice of the CIT, he can very well consider it. However, it can be only relied upon by the CIT if the same is there, if the same is present, if the material or information is present when the 263 notice gets initiated. When the section 263 is invoked by the commissioner. So when he is deciding that yes, the assessment order is erroneous, whatever records are present at that moment, though the records be not available at the time of assessment stage, but are available today when he is examining the case, those records can very well be considered, but the records should be at the time when he is deciding that this assessment order is erroneous. So once he examines that, he will issue a notice under 263 that yes, the assessment order is erroneous and therefore 263 is to be initiated. So yes, the first notice was very well correct. But the second notice, which was based on the material collected in the survey, was not relevant to the first notice, first of all. And it was not a material which was present at the time when 263 was initiated. And therefore, the second notice was not a valid action by the CIT. Is that clear? Is that clear? Clear? Okay. Any doubt if you have? Before we proceed to the next topic. Any doubt? Okay. So let's start with the next topic. Now, before penalties, there is a very small topic which is a new insertion to your syllabus, which is Dispute Resolution Committee. A very, very small topic, which is a new chapter, which is Dispute Resolution Committee. Now, what is this Dispute Resolution Committee? Let's try and understand. So earlier we used to have Settlement Commission, right? Now that is not going to be there after 1st February 2021. So after February 21, no application can be made before the Settlement Commission. However, there is an interim board which is available, but that's just an interim board for settlement for the cases which are pending, right? But to provide the certainty to the small taxpayers, a new Dispute Resolution Committee has come into existence. Now, what is this Dispute Resolution Committee? This is for the small taxpayers. This is for the small and medium taxpayers. So, what are the criteria? Here, this particular committee has not yet come has not yet become functional. But this is what the scheme is. That in respect of the disputes which are there from any variation in the assessment orders. Now, what kind of order? Where the additions which are made do not exceed rupees 10 lakhs. So the additions are rupees 10 lakhs. Dispute resolution committee. Addition less than rupees 10 lakhs. The order is not based on search or survey or any exchange of information from foreign. So, assessment order other than based on search, requisition, survey, and foreign information received under exchange of information, where the total income as per the return of income is less than 50 lakhs. Your total income less than rupees 50 lakhs as per your ROI. Is that clear? The assessee should not be in respect of whom the detention order has been made under COFEPOSA Act, which is Conservation of Foreign Exchange and Prevention of Smuggling Activities Act. So he's not convicted into any smuggling activities, right? He's not detained under that. Second, he is not prosecuted under IPC or Narcotic Drugs Act, right? Or Prohibition of Benami Transactions Act or Corruption Act or Prevention of Money Laundering Act. So he should not be convicted in all those acts, right? In respect of whom he is being prosecuted under Indian Penal Code. All that should not be there against the assessee. So it should not be, assessee should not be convicted under IPC, PMLA, Benami transactions, all these acts, right? Is that clear? And the Dispute Resolution Committee will also have the power to reduce or waive any penalty which is imposed under the Act, or it can also grant any immunity from the prosecution also, which is being put on the assessee. Is that clear? So this is about the Dispute Resolution Committee. Clear? This is only for the small taxpayers, as you can see. Clear? A theory question can come on this particular chapter. Any doubt till now? Yes, Santosh, next notice is not valid. The second notice was not valid. Correct. Okay. Let's start then with the penalties chapter. Finally, we can start now with the penalties chapter. Clear? So now, what are the penalties which we are going to discuss? First, we are going to discuss the most important penalty. Before we move on to we will discuss first the important penalties which is relating to the underreporting, misreporting of income, and Then we will talk about the penalty in such cases, and then we will finally discuss few more important penalties, and then the miscellaneous penalties which are there, which we would have already discussed in the other topics also, but we will just have the revision. So penalties. First, we are going to talk about section 270A, penalty for underreporting and misreporting of income. So earlier, before 2017, we used to have penalty for the concealment of income under 271(1)(c). Now we have penalty for underreporting and misreporting of income under 270A. Now, what is underreporting and misreporting of the income? Let's try and understand. But before that, understand one thing very clearly. Who is empowered to initiate this? The assessing officer has the power. The AO, for that matter, even the CIT appeals has the power to initiate this penalty. So AO, CIT appeals, PCIT or CIT. PCIT or CIT can direct the levy of this penalty if a person has underreported or misreported the income year, right? Well, what is underreporting? What do we mean by underreporting? So, underreporting can be said to be in different cases where the return of income is filed, where the ROI is filed. In that case, A is greater than B. What is A? If my income assessed is greater than, income determined in the summary assessment 143(1), in the return processed under section 143(1). So not the income offered under section 139, which is the ROI file, but the income determined under the return processed under section 143(1)(a). So if ROI has been filed, if the income assessed as on today is greater than the income determined in the return processed there under 143(1), that will lead to the underreporting of income. That means I have underreported the income. Is that clear? In case the ROI is not filed, or ROI is filed in response to reassessment notice under section 148. So when 148 is issued, you are required to file the return of income, right? So at that time, if the income assessed, so if you have not filed your return of income, or if you have filed in response to 148, greater than the basic exemption limit. If no return of income has been filed and income assessed greater than basic exemption limit, that means you have underreported the income. In case there is reassessment, under 147, then it is going to be income reassessed. It is going to be income reassessed if it is greater than income assessed. So quite possible, whatever the income first original assessment would have been happened at that time, the income assessed in the original assessment, if it is less than the income reassessed, so means income reassessed it is greater than the original assessment income, then it is a case of underreporting of the income. Is that clear? Clear? Now this is where the normal provisions are applicable. In case the MAT is applicable, so if ROI has been filed, if the ROI is filed and the assessment or reassessment, is based on MAT or AMT. If the ROI is filed and the assessment or reassessment is based on MAT or AMT, then if your deemed total income, as per assessed or reassessed as per 115 JB or JC, if it is greater than deemed total income determined in return processed under section 143(1). So same as the general provisions only or the normal provisions only, where no ROI is filed and assessment or reassessment is based on MAT or AMT, then if no ROI is filed, or for that matter even the return is filed under 148, no ROI is filed or filed under section 148, then in that case the amount of deemed total income under section 115 JB or JC, if it is greater than the basic exemption limit, now basic exemption limit will be applicable only for individual HUF, right? AOP, BOI, where AMT applies. It does not apply in case of MAT because companies do not have the basic exemption limit, right? Is that clear? And if it is a case of reassessment as per Section 115 JB or JC. If the reassessment is as per MAT, then deemed total income as per Section 115 JB or JC, if it is greater than the deemed total income before assessment. Deemed total income reassessed as per Section 115 JB or JC. Deemed total income assessed as per 115 JB or JC. Clear? Also, in case of the losses, if there is a loss case, there will be underreporting of income. It will be considered that the income has been underreported if in that case the income assessed or reassessed has the effect of either reducing the loss or converting the loss into income. Is that clear? So the loss is going to be converted to income, then it will be a case of reassessment. Or if the loss is getting reduced, then it is a case of reassessment. Clear? So then it is a case of underreporting of income. Is that clear? So in all these cases, it will be considered that the assessee has underreported the income. Any doubt till now? Any doubt? Now what will happen if there is underreporting of income? If there is underreporting of income, then penalty will be 50% of the tax on the underreported income. So if it's a case of underreporting of income, then the penalty is for underreported income, it is how much? 50% of tax payable on underreported income. In case of misreporting, it is 200% of tax payable on misreported income. Is that clear? So in case of underreporting of income, it is 50% of the tax payable on underreported income. In case of misreporting, it is going to be 200% of tax payable on misreporting of income. Now, when it will be considered that you have misreported the income, we saw the cases that when it will be considered that you have underreported the income. But what about misreporting of income? So what are the cases where it results in misreporting of the income? So misreporting, which cases will result in misreporting of income? Misrepresentation of facts, misrepresentation or suppression of facts. If the assessee is hiding certain facts, then it will be the case of the misreporting and not the underreporting. Failure to record the investments in books of accounts. If the assessee fails to record the investments in books of accounts, or claim of expense not substantiated. Claim of expense not substantiated with evidence. So you have claimed any expense, but you do not have any invoices in relation to that. Right? Recording false entry in books of accounts. If you have recorded any false entry in the books of accounts, it will be misreporting of income. Failure to record any receipt in the books of accounts. Failure to record any receipt in books of account, which can be considered as income. Last, failure to report international transaction or deemed international transaction. Failure to report international transaction or deemed international transaction or specified domestic transaction under transfer pricing. So all these cases will be misreporting of income. Is that clear? All these cases will be considered as misreporting of income. Clear? Any doubt? Namita, if the loss is reduced, we will see how we compute the tax in those cases. Santosh, how increasing the loss is considered as underreporting? Yes, it could be the case that you are trying to, record the losses, record the expenditure by claiming the false expenditure. So you are claiming the false expenditure. So that's what is covered under then misreporting if your claim of expenditure is not substantiated by any evidence. But if it is seen that you had claimed some fictitious losses, and those losses now, when they are being assessed, those losses are being disallowed. You might have claimed the excessive losses. Why would the department will allow you the excessive losses than what you have claimed in the return of income? Department is at loss only, right, for that. So if your losses which are claimed, which are fictitious in nature, and it has if the additions which the department is making now, by virtue of which your loss is turning into income or your loss is getting reduced, then that is a case of underreporting of income. Is that clear? Akshay, I clearly told you all these cases which are relating to the misreporting. If there are any incomes which are suppressed, which are not, or the facts which are suppressed, the investments are not disclosed in the books of account. These are very common examples that the investments are not recorded in the books of account. The expenditure are not substantiated. These are very, very common cases of misreporting of income. Is that clear? Santosh, AIS or TIS income or expenditure is greater than assessed ROI. No, Santosh, misreporting, we cannot say that AIS or TIS is all right. But even in case if it is, say for example, there could be anything which is not reflected in AIS or TIS also. There could be many cases. For example, my expenditure is not substantiated with proper invoices, with proper, say for example, I have claimed purchases which are not substantiated with the goods which are received. These are called generally as hawala purchases. So it could be anything. For example, that I have not reported any international transaction in my transfer pricing report. That could lead to misreporting of the income. Right? Is that clear? Namita, as I said, I'll tell you how in the case of loss, we will calculate the underreporting of income. Just wait for some time, you will get the answer for that. Okay, let's proceed further then. So now, how do we calculate the underreporting of income? That's the first step. We understood what is underreporting of income. What are the cases which give rise to the underreporting of income? But how do you calculate the underreported income is what we are going to see now. Is that clear? So, calculation of underreported income. Calculation of underreported income. Now, the first case which we saw was that ROI is 5. Your ROI is 5, right? The first case which we saw, your ROI is 5, correct? Is that clear? So now if the ROI is 5, then in that case, income assessed, the ROI if it is 5, if the income assessed minus the income determined in the return processed under section 143(1). So income assessed minus income determined in the return processed under section 143(1), where ROI is not filed. Where the ROI is not filed, then for the individuals or other than companies, it is going to be the assessed income minus basic exemption limit. And in case of companies, since there is no basic exemption limit, it is income assessed only. Clear? Where the reassessment case is there. So where there is reassessment of income, in those cases, it is going to be reassessed income minus income assessed earlier. Is that clear? In case of MAT cases, whether you have the return of income filed or you do not have the return of income filed, or it was a reassessment case, in this case, your underreporting of income will be A minus B plus C minus D. Now A is your A is total income assessed as per the normal provision. Total income assessed as per normal provision. Correct? Total income assessed as per normal provision. Clear? Your B is total income as per normal provisions without underreported income. So here you have to include underreported income, and here in B you have to exclude, and on the total income you have to calculate the tax without including the underreported income. C is your total income as per MAT. Your C is total income as per the MAT. Total income assessed as per the MAT. Clear? Minus D is total income. D is your total income without total income as per MAT. Without underreported income. Clear? Is it clear? And finally, in the loss case, your underreported income will be loss claimed minus income or loss assessed or reassessed. So loss claimed minus income or loss assessed or reassessed. Is that clear? Any doubt? Any doubt till now? Clear? Namita, now did you understand in case of loss, how will we compute it? Is that clear? Now, once you know the underreported income, as I said, it is 50% of the tax on underreported income. The penalty under section 270A is 50% of the tax payable on the underreported income. So we know how to calculate the underreported income. But now, the tax or the computation of tax on underreported income. How do we compute the tax on underreported income? How do we compute that? In the first case, where your ROI has been in the case where the total income, or let's say where your ROI is filed and total income is either determined under section 143(1) or under section 143(3) or 147. So it is assessed in the summary proceedings, or it is the original assessment or reassessment. Right? Then in that case, what will happen? The tax on the total income will be the tax on the underreported income, tax on underreported income plus the total income, your tax on the underreported income, right? Plus your total income determined either under section 143(1)(a) or under 143(3) or under 147, right? total income assessed under section 143(1)(a) or 143(3) or 147, right? Is that clear? Less minus tax on total income determined under section 143(1)(a) or 143(3) or 147 in a preceding order. Is that clear? So in the first point, what I'm doing is calculating the tax on the underreported income plus the total income which was assessed under 143(1)(a) or 143(3) or 147 as the case may be, minus the tax on income without considering the underreported income. Is that clear? Where no ROI is filed, where I have not filed the ROI, or it has been filed under 148 or filed under 148, then in that case it will be the tax on the underreported income plus basic exemption limit. So it will be tax on the underreported income plus the basic exemption limit. And in case it is a loss, if it is a case of loss, then in that case it will be tax on underreported income, Clear? The tax on the underreported income will be your tax in the case of loss. Is that clear? So in the loss case, it will be a tax on the underreported income. Clear? Any doubt till now? Namita, did you understand now? Namita, in this case, what we are doing is in the MAT cases, it is total income as per the normal provisions, including the underreported income, minus the total income without the underreported income as per the normal provision, plus the total income as per the MAT, minus the total income as per the MAT but without considering the underreported income. So A minus B will give us the result that how much is your underreported income as per the normal provision. Because total income including the underreported income as per the normal provision minus the total income without considering the underreported income. So this A minus B is going to give you the underreported income as per the normal provision. Plus C minus D will give you the result underreported income as per the MAT provision. Because you have to include total income as per the MAT, which is assessed or reassessed, minus the total income as per the MAT without including the underreported income. Clear? Is that clear, Namita? Any other doubt? Okay. So this is how you need to calculate the tax on the underreported income. Right? Now understand there are certain cases where it is not considered that there is underreporting of income. So cases not falling within the scope of underreported income. What are those cases? Where the assessee is offering the explanation for the income. So, first case is explanation offered by assessee with respect to income, and the AO or CIT, PCIT or CIT appeal is satisfied with the explanation of the assessee, that he is giving the bona fide explanation, and the assessee has disclosed all the material facts to substantiate the explanation. So explanation is offered by the assessee with respect to an income, and AO or CIT appeal or PCIT is satisfied with assessee's explanation that it is bona fide. Is that clear? So where the assessee is able to give the explanation, assessee is able to explain his income, then it will not be the case of underreporting of income. Or for example, determination of underreported income on the basis of estimate. So where, say for example, the assessee's accounts are correct and the income tax officer is also satisfied, but the assessee has estimated the income because his income cannot be properly examined. For example, in the 44 AD also, we do not usually maintain the books of accounts, right? And it is mostly based on the estimated basis, right? So in that case, if the accounts of the assessee are correct and the AO is satisfied that the income of the assessee is also based on some estimates, then in that case, it will not be the case of underreporting of income. Because an estimate could be, say, for example, 40% of profit also. It could be tomorrow, you can say 45% of the profit also. It was just my estimate. So if there is an estimate and if the accounts are correct, or even if, say, the assessee has estimated, say, for example, it could also be possible that the assessee has estimated a lower disallowance, whereas the AO feels that it should have been the higher disallowance. But the assessee himself has disallowed certain expenditure by the way of estimate, and he has disclosed all the facts material to that particular disallowance, then it will not be a case of underreporting of income. Clear? Further, third case, underreported income, which is by way of an addition to the arm's length price determined by the transfer pricing officer. So, addition due to ALP determined by TPO. So in that case, it will not be case of underreporting of income if the assessee has maintained all the documents for the transfer pricing under section 92D. He has declared the international transaction. If he has not declared the international transaction, then automatically it is a case of misreporting of income. But if there is underreporting, say for example, transfer pricing is very subjective exercise. I may use one method, AO may use another method, and because of which there could be additions. I may use one comparable, AO may use another comparable. So that will not mean that there is underreporting of income, but I should have maintained all the information under section 92D, all the documents of transfer pricing, and should have declared the international transaction. right? And the last case where there will be no underreporting will be a case of undisclosed income. Undisclosed income in case of search. Why? Because for that we have the penalty under section 271 AAB. We have the penalty under section 271 AAB. So again, there will not be penalty under section 270A. Is that clear? Any doubts? Clear? So in all these cases, there will not be the underreporting of the income. Any doubt? So you understand what is underreporting, what is misreporting, how the underreporting income is to be calculated, and how the tax has to be calculated on that. And then finally, the penalty will be 50% of the tax on the underreported income. Now, few more things. Understand one thing. If you remember when we were dealing with income tax authorities chapter, I had told you that the CBDT has power to waive off certain things, right? Or to grant the relaxations. Now, CBDT has also the power to relax the penalty under section 270A. CBDT has that power. So if the assessee makes the application and it is bona fide cause, then the CBDT may relax the provisions of the levy of penalty under section 270A. It is not that CBDT will entertain in every case. Also, it could relax the provisions for certain assessees, or it could issue the notifications in those regard, right? Further, if the CITA initiates the penalty and 270A CIT is empowered, the order can be appealed before the ITAT. The order can be appealed before ITAT. Further, understand one thing. There are certain penalties which will apply in addition to the penalty under section 278. What are those? If you do not maintain the books of accounts as required under 44A, then the penalty under 271A of 25,000 will be in addition to 270A. Similarly, under transfer pricing, if you fail to maintain the information under transfer pricing also, there will be misreporting of income if you do not report international transaction. Also, there will be penalty under 271AA of 2% of the value of international transaction under 271AA, right? Which will be in addition to 270A. Is that clear? Clear? Any doubt? Also, there are prosecutions if you underreport the income. So if you evade any tax, penalty or interest, there will be a prosecution which we will learn in the next class. We are going to learn about the prosecution in the next class, right? Okay. Any doubt till now before we go on to sums? Before we take up the sums, if you have any doubt, or let's start taking the questions from your module. We'll discuss the questions so that you know how to calculate the penalty. Clear? Is that clear? So let's start solving sums. Okay. So this is the first question. XYZ is a firm liable to tax at 30%. The following are the particulars furnished by the firm for AY 2023. As per the ROI furnished under 139, 150 lakhs. Determined under 143, 1A, 60 lakhs. Assessed under 143, 75 lakhs. Reassessed under 147, 95 lakhs. Can the penalty be levied under 270A? If the answer is in affirmative, compute the penalty leviable under 270A. So, give me the answers. We have done that already, all of it. It should be a very simple answer. Two minutes time. Santosh, they can go to High Court or Supreme Court only if it's a question of law and not of fact. Remember that thing. Quickly tell me what will be the answers. What will be the answer? Quickly. Yes, Geeta, correct. That's correct. Very nice. Akshay, yes. Naveen, no, that's not the correct answer. Namita, that's a deemed tax, what we are seeing, right, on the loss. Okay, let's try and solve that question. So in the first case, if you see, it is income determined is under 143(1)(a) is 60 lakhs. Assessed income under 143(3) is 75 lakhs. Right? So 75 lakh minus 60 lakhs. So 75 lakh is greater than 60 lakhs. So yes, there is going to be the underreporting of income. This is how you need to write. First, you need to say yes, there is underreporting of income. Because income assessed under 143(3) is exceeding the income determined under section 143(1)(a). Even in the second case, the income reassessed is greater than the income assessed under 143(3). So yes, there is an underreporting of income. And for underreporting of income, the penalty is 50%. Then you need to show how the income is calculated, which is 75 lakh minus 16 lakhs is 15 lakhs. On this 15 lakhs, there will be the taxability, right? How you will be determining the taxability? What did I tell you? So tax on the underreported income of 15 lakhs plus what? Plus your income determined under 143(1)(a), 60 lakhs. So on 75 lakhs, you will calculate, this is a company, this is a firm, this is a partnership firm. So you will calculate 30% plus the cess of 4%. Right? Minus the tax on the income determined under 143(1)(a), which is on 60 lakhs, you will calculate 30.4%, 30% plus 4% cess. That you will reduce from the tax on 75 lakhs. So 23 lakh 40,000 minus 18 lakh 72,000 will give you 4,68,000, which is the tax payable on the underreported income. So 30% on 75 lakh minus 30% on 60 lakhs. Of course, you have to add the cess also. And on that amount, you will have penalty at the rate of 50%, which comes to 2,34,000. Clear? In the second case also, it is going to be 95 lakh minus 75 lakhs. So 20 lakhs is your underreported income. Now 30% on 20 lakhs plus 20 lakhs plus 75 lakhs. Right? Which comes to 95 lakhs. So on 95 lakhs, 30% plus cess minus the tax on 75 lakhs without considering the underreported income, which is 30% on 75 lakh plus cess. So you get tax on the underreported income as 6,24,000 and penalty is 3,12,000. Is that clear? Is that clear? Shall we do a next question? Any doubt? Yes, Akshay, correct. Okay. Let's discuss the next question. Mr. Ram, a resident individual of age of 55 years, has not furnished the return of income for AY 22-23. However, the total income assessed in respect of such year under 144 is 12 lakhs. Is penalty attracted under 270A? And what is the quantum of penalty? Assume he has not opted for 115 BAC. So, what will be your answer here? What will be your answer? Yes, Akshay, correct. Surcharge could be applicable if it is more than 1 CR. This is also a very simple question. Quickly give me the answers. Yes, Geeta, correct. Naveen, no. Yes, Akshay, correct. Okay, let's discuss this question. So here he has not furnished the return of income and the total income assessed is exceeding the basic exemption limit, right? The assessed income is 12 lakh, which is exceeding the basic exemption limit. So you have to write, yes, there is underreporting of income since Mr. Ram has not filed the return and his income assessed is greater than the basic exemption limit. Hence, 270A will be applicable. Now, total income assessed under 144 is 12 lakhs. Basic exemption limit is 2,50,000 only. So it will be 9,50,000, right? Tax will be on how much? How will you calculate tax in this case? So here it is 12 lakhs is your income, right? For the return of income not filed, what did we say? That the tax on the underreported income plus the basic exemption limit. Plus the basic exemption limit. So here 12 lakh minus 2 lakh 50, 9 lakh 50 is your underreported income. Plus the basic exemption limit. Correct? Isn't it? So which comes to how much? 12 lakhs only. So on that 30% plus 4% and the penalty on that will be 50%, which comes to 89,700. Is that clear? 89,700. Clear? Any doubt? Santosh, not 179,400, it is 89,700. 179,400, yes, is the underreported income. So 89,700 is the penalty. Yes. Is that clear? Okay. Last one question, which is a loss case. So this is your question. As per the return of income, this is a company, domestic company for 25%. Return of income, 15 lakh loss. Determined under 143(1)(a), 8 lakh loss. Assessed under 143(3), 5 lakh loss. And finally, reassessment under 147 is 4 lakh total income. So, give me the answers for this. What will be the answer here? Yes, correct. Akshay, very good. What about reassessment? No, Geeta, not the correct answer. Akshay, yes, that is also correct. Reassessment one is also correct. Very good. Okay, let's discuss it. Let me solve it because many students have not got the answer. Okay. So now, first of all, if you see the loss assessed under 143.3 was lower than the loss determined under 143.1a, right? So therefore, it's a case of underreporting of income. Now, how will you calculate the underreporting here? Underreported income, loss assessed under section 143.3, which is 5 lakh, minus loss determined under section 143.1, which is 8 lakh. So minus 5 lakh minus 8 lakh, which is plus 8 lakh. Minus 5 lakh plus 8 lakh gives you 3 lakh, isn't it? On this 3 lakh, you have tax at the rate of 25% plus cess at the rate of 4%, which in total will come to 78,000. Correct? On this, penalty at the rate of 50%, 39,000. Is that clear? So 39,000 will be your penalty amount. With respect to the reassessment, now reassessment, the loss of 5 lakh is getting converted to total income of 4 lakh. So obviously again there is underreporting of income. So in that case, this is case 1, this is case 2. Total income reassessed under section 147, which is your 4 lakh minus loss assessed under section 143, which is 5 lakh. Now 4 lakh minus 5 lakh, which becomes plus 5 lakh. So 4 lakh plus 5 lakh comes to 9 lakh. Tax at the rate of 25% and again cess at the rate of 4%, which comes to 2,34,000. And penalty at the rate of 50% comes to 1,17,000. Is that clear? Is it clear? Yes, Santosh. Clear? Any doubt till now? Did you understand now how you calculated the loss cases? All right. This is very, very important section of your penalty chapter, the most important section. And most simplest also if you do it correctly. Let's take a small break then if there are no questions. And then we get on to the next topic. All right. Let's take a small break. Yeah. Yes, Ravi, you are correct. The penalty is 39,000 on the reassessment. Sorry, in the case of assessment. Any other question? Okay. Let's proceed then further. Clear? Okay. Now, next penalty, what we are going to talk about is in relation to the undisclosed income. Is in relation to the undisclosed income, which is under 271 AAC. AAC. Now, what does 271 AAC penalty is on? Let's try and understand. So, in a case where the income is an undisclosed income. Now, what are the different undisclosed income? Do you know that? So, section 68, 69, 69A, B, C, all of that deals with the undisclosed income, undisclosed investments, right? What is section 68? What is section 68? Anybody, what is section 68? The cash credits, right? The cash credits. Now, in respect of these cash credits, what happened is that it is quite possible that the assessee, is having certain amount credited in the books of accounts maintained by him, right? So the assessee has the credit of a sum. It could be any credit. It could be any credit, right? It is not necessarily that there has to be the cash receipt. It would cover loan, receipts, trade credits, credits in the capital account, any kind of credits, which are credited to the books of accounts of the assessee, and the assessee is not able to offer any explanation about the nature and source of those credit. So there are certain amounts which are credited to the books of accounts of assessee, for which the assessee is unable to offer any explanation regarding what is the nature of this credit and from where he has received. So nature and source. Or even if he offers the explanation that is not satisfactory to the AO, then the amount which is credited, the sum which is credited, is considered as deemed income under section 68. It's considered as deemed income under section 68. Correct? Also, in the case of a company, other than the closely held companies, other than the public companies, especially in the case of the closely held company, where the share capital is there. In the case of closely held companies, the amount which is credited to the share capital or even the share application money or share premium, where the assessee is not able to give any explanation regarding from whom he has received the share capital. And if it has the resident investors, resident shareholders, even the shareholders need to explain that what is the nature and source of their investment in the company. If they are not able to do that, then that is considered as deemed income under section 68. That is considered as deemed income under section 68. right? Similarly, we have section 69, which is unexplained investment. So where the assessee has not recorded the investments in the books and he is not offering the sufficient explanation, that value of investment is considered as deemed income. Section 69A, unexplained money. Where the assessee is having any bullion, money, jewelry or any other valuable article which are not recorded in the books of accounts, and where the assessee is not able to offer the satisfactory explanation about the nature and how he has acquired the asset, the nature and the source of the asset, that is considered as the deemed income. Similarly, section 69B, which is investment not fully disclosed in books of account. So the actual investments or the actual jewelry or valuable article is exceeding the amount recorded in the books of account. Assessee has disclosed the investment, but he has reduced the rate or reduced the value of those investments than what actually he has the investments. Section 69C, unexplained expenditure. So where the assessee has incurred any expenditure for which he has no explanation completely. And section 69D, which is amount borrowed on hundi. Borrowed or repaid on hundi. Now all of these are considered as deemed income. Are you getting that? These are considered as deemed income. Now the taxability is governed under section 115BE. So if you have any of these income, then the taxability is under section 115BBE. So if you have any of this income and you have disclosed it in your ROI, or even if you have not disclosed in your ROI, it is determined by the AO. The AO in the assessment order has included this income. Then under section 115BBE, the tax will be at the rate of 60% plus surcharge of 25% plus cess at the rate of 4%. Is that clear? Is that clear? So this is what the taxability will be under this particular section 115BBE. Right? So effective almost you have 78% tax rate. There is an effective tax rate of the 78%. Right? Now, this is the taxability under 115BBE. There is penalty under section. There is also a penalty under section 271 AAC. There is penalty under section 271 AAC. And what is the penalty amount? So the penalty amount which is going to be there, it is 10% the penalty amount is 10% in case penalty at the rate of 10% in case where the assessee has voluntarily, or let's write it this way, in case where the income determined includes any income under section 68 to 69D. Is that clear? So penalty is 10% in case where the income is between 68 to 69D. Is that clear? So in cases where the income assessed by the AO is including 68 to 69D, the penalty will be 10%. Now understand one thing very carefully. As I said, there could be income under 68 to 69D, and the assessee can voluntarily disclose in ROI file, or it is income assessed by the AO. So where the assessee is voluntarily disclosed in the return of income file before any notice is issued to him by the department or before any search is being carried out, right? So return must be under return filed under 139, right? And not the return filed under 148. If a notice is issued under 148 to file the return of income, that is not a voluntary disclosure. That is not a voluntary disclosure. So disclosed in ROI filed under section 139, original, revised, any return of income, belated, whatever it may be. But it should be return filed under 139 and not under 148, not in response to notice under section 148. If that be the case, there is only tax at the rate of 78% under section 115 BBE. There will be no penalty in this case. Because obviously assessee has voluntarily disclosed. So there will not be any penalty. In case where the income is assessed by the AO, then in that case, there will be tax at the rate of 78% under section 115 BBE. Also remember, there are no deductions allowed against this income. This is the taxability on gross basis, right? Plus here, penalty will be applicable under section 271 AAC at the rate of 10%. So penalty will be only in this case. Is that clear? Is that clear? Any doubt? And if you have the penalty under 270, if you have the penalty under 271 AAC, then you will not have any penalty under section 270A. So this, no penalty again for underreporting or misreporting under 270A. So if there is already a penalty being levied, under this section, then no other penalty under 270A. Is that clear? Clear? the income, if these undisclosed income are found out during the search, so if it is undisclosed income assessed by the AO other than search, if it is found during search, if it is found during search, then you have 271 AAB. So if it is found during search, then penalty will be under 271 AAB. Are we clear? Are we clear? Any doubt till now? Now we are going towards 271 AAB. Now what is 271 AAB? Let's try and understand. Now 271 AAB is penalty in search cases. So penal provisions, penalty in, or let's write penalty on undisclosed income during search. Right? That is under section 271 AAB. Now what is that? So if the undisclosed income is admitted during the course of the search, so you know that the assessee is required to furnish a statement during search, and if the assessee admits during the search and the assessee explains the nature and the source of that income, the assessee is ready to pay the tax in respect of that income. He files the return of income declaring that undisclosed income. Then the penalty will be 30%. So in case where undisclosed income is admitted by assessee during search, if the undisclosed income is admitted by the assessee during the search in statement, the assessee explains the manner, nature and source of income derived. Assessee pays the tax with interest. He pays the tax with interest on undisclosed income, declares the undisclosed income, in ROI, in the return of income, right? On or before a return of income for the specified previous year, on or before the specified date. What is the specified date? Specified date is the due date of filing of return of income or the date on which the notice issued under section 153A expires. So specified date is what? Due date of ROI, due date of ROI or date specified in notice under section 153A. Right? So in case the assessee is declaring, is admitting the income, he is explaining the nature and source, he is paying the tax, and he is offering this particular income, then in that case, this will be at the rate of, the penalty will be at the rate of 30%. Here it is, now it is not 153A, it is now 147 because now there is no 153A, right? Now we have everything under 147 only. Earlier we used to have 153A. Correct? So if he furnishes the return of income before the due date specified under section due date of return of income under 139 or the notice specified under section 148 or rather 147 or 148, then in that case the assessee will have the penalty of 30%. The assessee will have the penalty of 30%. Is that clear? Is that clear? So this will be, the act now also says here 153A, but in actual it is now 147, 148. If you remember, we have done that. 153A is now no more longer there, right? So here the penalty is 30%. The penalty amount will be 30%. Is that clear? Is that clear? Any doubt? So, in any other case, if the assessee does not declare the income or does not admit it or does not pay the tax, so in any other case, it is going to be 60% of the undisclosed income. And here it is going to be 60% of clear? Is that clear? So if it is not a search case, then penalty is at the rate of 10% of tax under 115BB. But if it is in the case of the search, if the undisclosed income is found during search, then it is 30% or 60%. And if the assessee has voluntarily disclosed it, not in the cases of the search, then it is no penalty. Is that clear? Is that clear? Any doubt? Again, when the penalty is imposed under 271A, there will be no penalty under 270A also. Any doubts? Yes, Namita, that's what I said. But the section still refers to 271A, B. If you read the section, it still refers to 153A. It should be the disclosure in the return. Yes, Namita. Okay. Any other doubt? Is it clear? Okay. Now, let's proceed to the next penalties, what we are going to discuss. This was for the search cases, right? Now, other than that, there are certain small penalties which we are going to cover, which is in the context of the cash transactions. So, penalty in the case of cash transactions. So, we have covered first for the undisclosed incomes. Now, what are these penalties? So, there are this section 269 SS and section 269 T. Now, what are these sections? Let's try and understand first, and then we will understand the penalty. So, any person is not allowed to accept. No person is allowed to accept any loan, deposit, or sum for transfer of immovable property. Sum for the transfer of immovable property, whether or not the transfer is taking place. It could be even advance, including advance for immovable property. So not necessarily that the essentially transfer of immovable property should take place. Even if the advance is given, that is covered. Right? So any person should not accept any loan, deposit, sum for transfer of immovable property, the amount of it exceeding rupees 20,000, otherwise than by account paid check or draft, account paid draft, or electronic clearing system, or electronic mode. Right? So no person is allowed to accept over rupees 20,000 any loan, deposit, sum for transfer of immovable property, or any advance for immovable property over and above rupees 20,000. Otherwise than by account paid check or account paid draft. Right? If the person violates that, if any person accepts more than 20,000 say in cash, then you have the penalty under section 271D, which is sum equal to your sum on transfer of property. Is that clear? Is that clear? So 271D is applicable in cases where you violate the provision of 269S or 269SS. Is that very well clear? Right? Similarly, also remember that for 269SS, 269SS is not applicable on loan accepted from government, banking company, post office, saving bank, or cooperative banks. So any loan accepted in cash from these banks is not covered by 269SS. Or where the persons are involved in agriculture. Where the person are involved in agriculture, on them also 269 SS is not applicable. Clear? Similarly, we have 269T. We have 269T. What is 269T? It says that 269T is very similar, but it is for the repayment. 269T is for the repayment. And what does it say? That no branch of a banking company or a cooperative bank or a cooperative society or partnership firm or any person shall repay any loan. This is on repayment. This is not to accept, and this is repay any loan, deposit, any loan or deposit or advance received for immovable property. Any advance received for the immovable property, right? In relation to transfer of immovable property, they shall not repay otherwise than by account pay check or account pay bank draft or ECS or electronic modes, where the amount exceeds rupees 20,000. Same provision, but here it is on repayment. Is that clear? So it should not be more than 20,000 in cash or otherwise than by account pay check. Clear? Again, this is not applicable to government, post office, saving bank. Any repayment of any loan or deposit accepted from government, banking company, cooperative society, cooperative banks, to them this is not applicable. So any repayment from them on loan taken from them, that is not applicable. But if you violate the condition of 269D, then you have the penalty under section 271E, which is again sum equal to the loan, deposit or repayment of the amount. Is that clear? Clear? Now this particular penalty which is there, this penalty is to be levied by the Joint Commissioner. This can be only imposed by the Joint Commissioner of the Income Tax. Penalty to be imposed only by Joint Commissioner of Income Tax. Is that clear? Clear? Any doubt? Now there are certain case laws regarding this. Okay, there are a few questions. If the assessee discloses income under 271A on notice under 148, yes, that is voluntary only. On that, it is going to be 30%. If it is due to search, then it is 30%. If it is not due to search, then it is 10% of the tax under 115BB. Clear, Namita? Suraya, I didn't get your question. Search case on the penalty or search, or will it be in addition to penalty under 271 AAC? No, there will not be. It will not be in addition to 271 AAC. It will be only penalty in search. Clear, Suraya? Yes, Namita. From bank it can be. Is that clear? Okay. Now there are certain cases on 271D which are frequently asked in your examination also. Now what are those cases? let's try and understand. So understand one thing, that for imposition of penalty under 271D and 271E, there is a limitation period. There is a limitation period by when the penalty notices or orders can be passed. By when the penalty orders can be passed. For example, we had the similar limitation period for assessment or reassessment also, right? By when the assessment orders can be passed. Similarly, we have the penalty orders limitation also. Isn't it? Now, limitation period for penalties is provided under 275 section. For example, for assessment or reassessment, we had it under 153, right? Similarly, for penalty, we have the limitation period under 275. Now, what does section 275 say? What does section 275 talks about? Let's try and understand that thing first. Section 275 gives the different time limits for the imposition of penalty. 275, so time limit for penalty imposition under section 275. 275 1A talks about where the assessment order is the subject matter of appeal before the CIT appeal. So where the assessment order is before CIT appeals, is subject matter of an appeal to the CIT, right? Is that clear? So 275 1A talks about that the assessment order is before the CIT appeal. So for penalty order, the time limit for the penalty order is later of expiry of the financial year, before the expiry of the financial year in which the proceedings of the penalty have been initiated. The proceedings which are there in the course of which the action of imposition of penalty have been initiated. So before the expiry of the financial year in which the assessment proceedings which were there, in the course of which the penalty has been initiated. Is it correct? So expiry of financial year in which your penalty the assessment is initiated or completed. So before the expiry, say for example, the assessment is completed in September 2021. So before the expiry of 31st March 22, you have to finish the penalty proceedings. Or the later of, what is the later of? Second, which is 1 year from the end of the financial year, 1 year from the end of the financial year in which CIT appeal order is received. In which CIT appeal order is received by the commissioner. Is it clear? So later off, where the assessment order is subject to the appeal, then later off expiry of the financial year in which the assessment is completed, or 1 year from the end of the financial year in which CIT order is received by the CIT. So that is the time limit of completion of the assessment order which is subject to the appeal. 275 1B talks about 1B talks about the assessment which is subject matter of revision. Assessment which is subject to revision under section either 263 or 264. 263 or 264. And what is the time limit for that? 6 months from end of the month in which revision order is passed under section 263 or 264. 6 months from the end of the month in which the revision order is passed. And for any other penalty, in any other case, it is again later off expiry of the financial year, in which your assessment is completed, or expiry of the financial year in which assessment is completed, or 6 months from end of 6 months from the end of month in which the penalty is initiated. 6 months from the end of the month in which penalty proceeding is initiated. Right? 6 months from the end of the month in which the penalty proceeding is initiated. Is that clear? From the time period, the time given to the assessee for giving him the opportunity of hearing is excluded. Or the time period in which the order of penalty, in which the penalty proceedings are stayed by the court, the stay is obtained from the court, that time period is excluded. Is it clear? Now, when do the penalty proceedings get initiated? Here it is written 6 months from the end of month in which the penalty proceeding is initiated. So, how do the penalty proceedings get initiated? They are initiated by the notice under section 274. Right? There are penalties which are initiated by the notice under section 274. Is that clear? So now, we are coming back to our discussion on the 271D and 271E. 271D and 271E. Is that clear? Now, 271D and 271E, what are the cases which we are going to discuss in relation to the time limit? In relation to the time limit under section 275. So with respect to 271D and 271E, there was a question. There was an important question which was raised before the High Court. There was an important question which was raised before the High Court. And what was that question? Let's try and understand. So the question was, what will be the limitation period for 271D and 271E? What is the period of limitation for 271D and 271E? Is it the limitation period which is there under 275(1)(a)? Will this particular point apply? Or will 275(1)(c) will be applicable? For 271D and 271E penalty, which time limit should be applicable? Whether it should be this or should it be this? That was the question before the Delhi High Court. So Delhi High Court in Worldwide Township Project Limited has considered this particular issue. And it observed that the penalty under section 271D and 271E is independent of assessment, is not dependent on the assessment of the total income. Here the penalty is on what? The penalty is on granting of loans or repayment of loans above the 20,000 limit, otherwise then through the banking mode. So 271D and 271E are not dependent on the total income which is assessed in the assessment order. So ideally, this particular time limit should not apply to 271D and 271E, because here it talks about the assessment order, right? So ideally this limit should not be applicable. So therefore the court said that 275(1)(a) time limit would not be applicable and provisions of 275(1)(c). So here 271D and 271E is covered by this time limit. Is that clear? Further, CBDT also has accepted this judgment and they have clearly said that 271D and 271E notices will be covered by the time limit of expiry of the financial year in which the assessment is completed, or 6 months from the end of the month in which penalty proceeding is initiated, whichever is later. So in this case, it will be 6 months from the end of the month in which penalty proceeding is initiated. Is that clear? Is that clear? So that was the first question which was there in this particular case. The second question, which is again relating to the limitation period, which is the time limit for passing the penalty order. The second question was that before the Kerala High Court, that whether the period of limitation for imposition of penalty under 271D and 271E, whether should it commence when the assessment order is passed by the AO or when the notice is issued by the Joint Commissioner of Income Tax. So that was the question before the Kerala High Court. So Kerala High Court in Graha Lakshmi Vision case, clearly said that the question is whether penalty proceeding under 271D or 271E, should it commence from the date when the assessment order is passed, or it is from the date when the Joint Commissioner issues the order. A joint commissioner issues the notice. So Kerala High Court in that case observed that it is very clear that joint commissioner is only empowered to levy this penalty. It is not the AO who is empowered. AO cannot initiate the penalty under 271D or 271E. AO can just mention in the assessment order that 271D or 271E could be initiated. So ideally, the assessment order cannot be taken as the initiation of the penalty proceedings because AO is very incompetent. AO is not competent authority to issue the penalty notices under 271D and 271E. Right? So therefore, it is from the date when JCIT issues the notice, from that date, the period of limitation will start. Again, CBDT has accepted this view of the court and they have clearly said that AO cannot issue any notice under 271D or 271E and the time limit will be from the date when the JCIT issues the notice. Is that clear? Any doubt? Namita, because 271 AAC clearly says that only if you disclose it under 139, then only no penalty. But if you disclose it on notice under 148, means what you are doing? You are giving a response to 148 by filing a return of income. Means the income tax department has already identified that your income has escaped assessment. And you're replying to that. So that is not a voluntary disclosure, right? Yes, Shiva, it is 20,000. Namita, if it goes into the banking mode, how it can be converting the black to white? Okay. Any doubt? Clear. There is one more case, which is a very recent case of Delhi High Court, where the question before the court was that whether the penalty under 271D is imposable for cash loans or deposits received from the partners of the firm. This was in the case of Muthoot Financiers, and many other high courts have also ruled on this particular point. So, some high courts have held that 269 SS would not be applicable when money is given or taken from the partners from the firm. When the partners receive it from the firm, their 269 SS will not be applicable. However, Supreme Court has held that the partners of the firm are distinct from the firm. Right? Supreme Court has held in some other cases, not in the context of 271D, but they have said it that partners are distinct from the partnership firm. High Court have held that 269 SS will not be applicable since partners and the firm are same. They are not separate legal entity. So Delhi High Court has also said that there is no question, there was no doubt on the source of the money. The transaction was bona fide. The creditworthiness and genuineness of the partners were also proven. And what Delhi High Court additionally said in here is that there are different legal interpretations and that could show a reasonable cause. Since there are different legal interpretations, that is a reasonable cause for not imposing the penalty under section 271D. Is that clear? So there are differing judgments which are there on whether the partners can accept the loans or deposits in cash. Is that clear? But for that, the penalty will not be levied because it's a reasonable cause since there are differing judgments. Is that clear? Is that clear? Okay, let's proceed then further to the next part. Now this is we did about 269 SS and 269 T, right? 269 SS and 269 T. Now there is one more section which is 269 ST, which is 269 ST. Now what is that section? 269 ST. 269 ST is with regard to 269 ST is with regard to receipt of money over and above rupees 2 lakhs. So where any person is receiving the amount greater than rupees 2 lakhs, where any person is receiving the amount rupees 2 lakh or more, other than by account pay check or account pay bank draft or ECS or banking mode. Right? From single person, from a single person in a day, or in respect of single transaction, or in respect of transaction relating to one event or occasion. Relating to one event or occasion from a person. Right? So in that case, 269 ST will become applicable. Clear? Again, 269 ST is not applicable where the receipt is by government, banking company, post office saving bank or cooperative bank. Transactions which are already covered under 269 SS, loan, deposit or transfer of immobile property, any sum regarding that. Where the receipt by any person from a bank, where there are cash withdrawals from bank, cooperative bank. So receipt by bank or cash withdrawals from bank, that are not covered. Right? Receipts on account of credit card against bill raised, all that is not covered. Even in respect of NBFCs, the CBDT has clarified that in respect of one installment, in respect of receipt in the nature of repayment of loan, so when the repayment of loan is being received, the one installment which is there of loan repayment shall constitute a single transaction. So not all the installments will be regarded as single transaction, but one installment will be regarded as single transaction for NBFC. Is that clear? But if anybody violates 269 ST, then there will be penalty under section penalty under section 271 DA. Penalty under section 271 DA, which is equal to the sum equal to receipt. Again, this can be imposed only by the Joint Commissioner. This can only be imposed by the Joint Commissioner. Is that clear? Is that clear? Further, any cash sale over and above 2 lakh by the farmers of agricultural produce is also prohibited under 269 ST. Right? So 269 ST, any cash sale of an amount of 2 lakh or more by a cultivator of agricultural produce is prohibited under 269 ST. Remember that. There is a CBDT circular for that. Is that clear? But the CBDT has now, this was earlier, but CBDT has now clarified that cash sale of the agricultural produce by its cultivator for an amount less than 2 lakh will not attract prohibition under 269 ST. So any cash sale of an amount of 2 lakh or more is prohibited under 269 ST. But cash sale of the agricultural produce for an amount less than 2 lakh will not attract prohibition under 269 ST. Is that clear? Clear? So the penalty, if at all there are violations, can be levied under 271 DA. Clear? Any doubt? Why will assessee report, Santosh? This department only will come to know about it. And then it can be initiated by the Joint Commissioner. Assessee will not report it. Okay. So that is 271 DA. Right? Next particular penalty is again for one of the cash transaction. For one of the cash transaction, which is in the case of acceptance of payment 269 SU section, which is acceptance of payment through prescribed electronic modes. Now, what is this section? 269 SU. 269 SU is a recently introduced section in 2019 only. It is applicable to any person whose total sales, turnover or gross receipts exceed 50 crores during the preceding previous year. So, applicable to person whose turnover greater than rupees 50 crores in immediately preceding previous year. They need to provide the facility of debit card, UPIs, QR codes. If they do not provide these facilities, then there will be penalty under section 271 DB. There will be penalty under section 271 DB, which would be 5,000 per day. Per day of failure, 5,000 rupees would be levied. Again, this is to be levied by Joint Commissioner of Income Tax. Is that clear? Again, this will be levied only by the Joint Commissioner of the Income Tax. Is that clear? So there will be rupees 5,000 per day penalty which will be levied. Clear? Any doubt? Any doubt? There is one more case law of Bombay High Court which I want to discuss with you. In the case of Trump International Finance, there the question before the court was where an assessee repays a loan by passing the book entries. So what assessee had done is it had payable, it had receivable. So it set it off against each other. Now this was more than rupees 20,000. So the question before the Bombay High Court was that can assessee who is setting off the adjustment by passing the adjustment entry, setting off the loan and showing the repayment, which is more than 20,000, is it in contravention of 269T and therefore penalty should be levied under 271E. So the Bombay High Court observed that here there was no doubt about the genuineness of the receipt of loan or the repayment of loan. Here what was done was that there was adjustment to the book entries which was carried out in the ordinary course of business. There was no doubt on the genuineness of the transaction. There was receivable, there was payable, and therefore the assessee, in order to avoid unnecessary transfer, he just set it off the amount of payable and receivable by passing the journal entry. It would just have been a formality to repay the loan by account paid check because it was receivable, it was payable. It would have just been a formality to waive the check and take back the check, right? Since there was no doubt on genuineness of the transaction, in this case, there would not be any penalty in this particular case. The court said that there is nothing on record to suggest that the amounts advanced to the assessee represented the unaccounted money of either party. But it also said that 269T is not making any distinction between a bona fide or non-bona fide transaction. It just puts up the condition that the loan is repaid by otherwise than the account paid check or the banking mode. Here, one could say that the assessee has contravened the provision of 269T by passing the book entry. However, since the transaction is bona fide, no penalty can be levied because a reasonable cause is being shown. So they are not saying that 269T is not applicable. They are just saying that the penalty will not be applicable because there is a bona fide cause which is shown. There was no doubt on the genuineness of the transaction. So 273B, section 273B says that if the assessee is able to prove that the transaction was genuine, then the penalty may be waived off. Penalty may not be levied. So 273B provides that the penalty will not be levied if the assessee proves that there was a reasonable cause for such failure. They are not saying that 269T is not applicable. They are nowhere saying that because 269T does not differentiate between a genuine and a non-genuine transaction. But if you show a reasonable cause that why you have done that, then the penalty will not be imposed on you. Is that clear? Any doubt? Namita, these were not the bogus entry. There was no doubt on the genuineness. If there is doubt on the genuineness, then there is no question of giving the relief. Geeta, yes, 269 SU is regarding the 269 SU is regarding the giving the electronic mode of payment while receiving the amounts. So an assessee or any person who has the turnover more than rupees 50 CR in the immediately preceding previous year has to keep these electronic modes while receiving the payments. He has to keep these electronic modes, which are RuPay, debit card payment through RuPay, UPI. So therefore, he has to offer these payment of mode. He has to keep these with him. It doesn't matter the other party pays through check or it uses these services. But he has to keep these QR codes and these electronic means for receiving the payment. If he fails to do so, it will be 5,000 per day penalty. Clear, Geeta? Yes, Namita, it will not be refunded. Any other doubt? Okay. So this is the second part of the penalties what we have completed, which is the which is in respect to the penalty in respect of the cash transactions especially, right? Now we will do other small penalties which I want to discuss with you. So penalty first for the payment of the tax. Payment for the default in payment of the tax. So if you remember, we had already done that while we were dealing with section 220. So if you make the default in payment of tax, you have section 220, right? So under 220, you are required to make the payment of the taxes, right? If the notice of demand under section 156 is issued to you within 30 days. Otherwise, you will have to pay the interest at the rate of how much it was? How much interest it was? Anybody remembers? So within 30 days of the 156 notice, you are required to make the payment of tax, right? Otherwise, you are required to pay the interest at the rate of 1% per month, if you remember. So 220 for 156 demand within 30 days. Else you had interest at the rate of 1% per month, right? But for that, the penalty also exists, which we had discussed that time also. It is under 221. Penalty under section 221, which is the amount as directed by the assessing officer. So this is at the discretion of AO, but it cannot exceed the amount of tax. It cannot exceed the amount of tax, right? So this is penalty which is in addition to your tax and the interest under section 220. If the AO is satisfied that the default was for the genuine reason or sufficient reason, then he may not levy any penalty. Is that clear? So this is the penalty under 221. This we had already discussed while we were dealing with section 220 also, if you remember. Right? Then other penalty is with respect to the TDS or TCS. This also we had done it. If you remember, this also we had done it. For the TDS or TCS, there are certain penalties. And what is that penalty? Let's try and understand. So for TDS or TCS, so specific penalties for them. The first penalty, if you remember, that if I do not make the payment of the TDS or TCS, correct? What was that? Anybody remembers? So failure to deduct the TDS or to pay any part of the tax. Any part of the tax is for 194B, then the amount equal to the amount of tax which the assessee fails to deduct or pay. So under 271C, failure to deduct or pay TDS. Now again, there was one case law on this aspect where the question before the court was whether 271C is also applicable when there is a failure to pay the tax, because 271C does not say about it. 271C just says that failure to deduct tax. But the court said that yes, 271C also includes the failure to make the payment of tax. So even if the tax is deducted but not remitted to the government, that is also included. Now this year, the penalty amount is the sum equal to the amount of tax. So TDS amount is your penalty, which you fail to deduct or pay. Again, this is to be imposed by Joint Commissioner of Income Tax. Similarly, we have it for TCS, failure to collect, which is also under 271 CA. 271 CA, which is failure to collect the tax. Again, here they don't say about the remittance. It just says that you are failing to collect. It's not saying that you have collected, but you have not remitted it to the government. So here it is the amount of failure to collect TCS. So I'm not writing here paying TCS. So here it is TCS amount, and again JCIT can impose it. JCIT can impose it. Is it clear? So here it is not including the word payment. Is that clear? Is that clear? Failure to furnish TDS or TCS statements. Again, this we had done that, which is under 271H. Failure to furnish TDS or TCS statements. Failure to furnish TDS or TCS statements within the time period. What were TDS, TCS statements? 24Q, 26Q. Remember, we had to do it quarterly, right? By 31st July. Remember? For that, the penalty is rupees 10K to rupees 1 lakh. Penalty is rupees 10,000 to 1 lakh. Again, no penalty would be levied if the deductor or collector proves that after deducting or after paying the TDS deducted or collected, he has paid it along with the fee and interest, and he had delivered within the period of 1 year. Within the period of 1 year from the prescribed time, he has delivered the statements. So it will not be levied if TDS or TCS paid along with fee under section 234E. Remember, 234E was there, which was 200 per day. If you do not file these TDS, TCS statements, this penalty is over and above that. And TDS, TCS statements filed within 1 year from prescribed time. Is that clear? Is that clear? Even if you furnish the wrong incorrect statements, if you furnish incorrect statements or you furnish incorrect information, then also the penalty is 10,000 to 1 lakh, but this will not be applicable. This particular point will not be applicable. Clear? Is that clear? With respect to 195 section, if you remember, every person has to give the information about the remittance being made, right? So if you give the incorrect information, inaccurate remittance information under section 195. 195 is for payment to non-resident. Then the penalty is rupees 1 lakh. Penalty is rupees 1 lakh. Is that clear? Clear? Next is last for the TDS and TCS 272 BB, which is for, this was 272I, sorry, 271I. 272 BB is for failure to comply with 203A. If you quote false TAN, if you do not obtain TAN, then it will be 10,000. So, failure to obtain TAN or quoting wrong TAN, the penalty is going to be 10,000. Is that clear? Any doubts? If fees is paid and if the statements are furnished within 1 year, Namita, then penalty will not be levied. If it is not furnished within 1 year, penalty will be levied. Yes, Santosh, that's correct. Yes, Namita, if TCS is not paid, there is no provision similar to if we have TCS not collected only. No, Santosh, AO cannot initiate the penalty where the JCIT is only authorized. (269) SU, Namita, I already mentioned that it is to the person who have 50 crores of turnover in the preceding financial year. Is that clear? Is that clear? Any doubts? If there are no further doubts, we can just stop over here. And the remaining penalties, there are only few penalties which are left. We'll complete it in the next class. Yes, Namita, 206AA is not applicable on long-term bonds. That is clearly mentioned, yes. Is that clear? Okay. So let's meet up in the next class. Thank you so much.